Those institutions are the accounting bodies of that particular country. India also, we have our accounting body. US also, or UK also, they have their accounting bodies, and their main job is like to design accounting principles which can help, you know, institutions or investors or even governments to bring more transparency in the business. With that said, if you see, we have two types of accounting models. One is trade date basis accounting. Note down this one. So you may expect questions around this. So we have accounting types. So we have trade date basis accounting. And another one is settlement date basis accounting. Take the example of securities. Let's say PE fund purchase securities, purchase bond, let's say at 1 lakh. 1 lakh. So here you will have to prepare accounting entry on trade date. So on trade date, you can record accounting entry where purchase debit to payable account credit. And for a seller, vice versa, seller will create a receivable account debit to sell account credit. Right. So you can prepare accounting entry in the books of seller also. So I am now preparing entry from the buyer perspective. And on settlement date, means let's say here you can follow T plus 2 rule. On trade date, you can prepare this accounting entry, and on let's say settlement date, so it means on once the actual settlement happen or executed in the books of, let's say, broker or custodian, and once you receive confirmation from them, then you can prepare accounting entry payable account debit cash account credit. So this is how you can maintain the records as per IFRS. And again, UK and US both gaps and even Indian gaps, they also support to this. It's optional, means if you want to follow trade date, you can follow. If you want to follow trade date, then you will have to prepare two separate entries. That's the process. And now your question would be like, sir, how can I recognize that means my fund is following which accounting method? So most of the funds, they means 90% funds, they follow the traded method only. Why? To avoid any kind of risk, and also this method is a very transparent and unique one. So now your question would be like, so what if same scenario, how can we record it under the settlement date basis? Under the settlement date basis, trade date, no entry required. If you have settlement date basis model or accounting practice, then on settlement date, sorry, on trade date, even buyer and seller, they'll not record any entry, no entry required. On settlement date, you can record accounting entry where investment account debit cash account credit, same price. So what if this price changed? This price changed. So it means on trade date, let's say interest wasn't accrued, but if you see T plus 2, let's say 2 days interest payment, let's say 100 added in the amount. So this amount means interest has been added in the amount. It's just a hypothetical example, but you can apply the same logic to the securities so that you know it. Security prices changes every moment, right? Every moment security price changes. What if I take the example, let's say instead of bond, if I take the example of stock, you purchase stock at this price, so it means on trade date price was same, right? But on settlement date price change, let's say like this. So it means how can you record that particular difference? In that case, your total investment value would be, let me investment cash account credit, because cash will out only 10,000, and if you see, you have a gain, unrealized gain account credit, which is 2,000. So it means if you follow the settlement date accounting, then you will have to also consider the gain as well. IFRS provide option, but UK gap doesn't allow this. UK and US, that doesn't allow this settlement date basis accounting for, at least for securities, right? And that's what, if you see, most of the companies, they follow only trade date basis accounting method, even in private equity, hedge fund, mutual fund, brokers, your custodians, and even other counterparts as well. But let me tell you the secret. If the custodian is doing accounting for them, then they'll follow the trade date. But the custodian, let's say, if they are following the or if they are, let's say, providing facility, accounting, it means bank statement facility. If they're providing bank statement facility or bank account facility to the client, then custodian will refer, or even bank will refer the settlement date basis accounting. If you see, bank never, let's say you guys are due with fees of 15,000, my fees is due from you, so bank will not record the due amount in any of the anywhere on the statement. I'll record it, because we means particular trade happened between you and I, not bank. That's what bank will not record anything on trade date. Bank will directly record that amount when the bank received it. So it means on settlement date. So when you make my payment, then only bank will record it. So this is how you can apply the logic, which institutions can apply the settlement date and which institutions can apply the trade date. But let me tell you the secret, as I said, if the bank is doing accounting for them, then bank will follow the trade date. But if a bank is doing accounting for the client, let's say depositors or lenders or any other counterparts, then bank will do the accounting on settlement date basis only. Same logic you can apply to the fund as well. Fund will do the trade date basis accounting. Why? Because most of the time, as I said, fund purchase securities, and that secure to avoid just prevent that risk from the transactions. Payable and receivable is a very essential portion for a fund business, and they create it. This logic applies to your private equity, hedge fund. Don't ask question like, is this applied to the mutual fund or any other funds? As I said, fund, it means that includes all funds. right? So I'm done with that, trade date basis or your accounting types, your trade date and settlement date. Now you can unmute and ask your questions, whatever questions that you have around with this discussion.
Shivraj.
Yeah.
Yeah, so we in the bond, the trade, where we also paid the interest to the seller. So
Hmm.
let's say we are buying it, the principal amount we are buying the bond, right?
Hmm.
So if we are paying the accrued interest to that particular person, then how come that is deducted from the principal amount?
Hmm. So what means, what is your question? What do you want to understand from this?
Yeah, let's say the bond principal amount is 1 lakh. Okay. So let's say he's selling off the bond on 31st or 30th
Hmm.
of December,
Hmm.
on which he's supposed to get interest of 10,000, which is 10% of 1 lakh.
Hmm.
So on that day, I will be buying the bond for 10 lakhs, sorry, 1 lakh, and plus I will be providing with the interest of accrued interest of 10,000, right?
Hmm.
Uh, yeah, but how come it gets deducted from the principal amount 10,000?
You don't need to deduct it while recording. See, you are paying only one cash, which is this amount. You are paying only 1 lakh. But while recording, so don't you think that? See, now I'll ask question in other way around. Record this total investment as a 1 lakh. I'm okay with it. I'm okay with it. But current market price of the bond is, sorry, it is a 1 lakh amount, 90,000. It's become 9 lakh, 90,000. So now, how will you adjust this? Now you tell me. I'm not asking you, forget this, logic, whatever that we have discussed, right? We know it that interest is included. But we have decided to record total investment and you recorded 1 lakh in the books of account because you don't wanted to record separately. When you check that price in the market, current market price of the bond is let's say 9,000. Now you tell me how will you record this?
So I will investment account that is 1 lakh.
Hmm.
Okay. To cash credit 90,000, and as on the maturity I'm supposed to get 1 lakh, and I have 10,000 price difference because of the current market price. So unrealized gain of 10,000.
To avoid all of that, there is no gain. Ultimately, your purchase price, investment value is 1 lakh and current market price is 90,000. So it means there is a loss of 10,000. Just to avoid additional work, that IFRS or let's say, accounting principles, they allow you guys to do one thing. So record the investment account debit only 90,000, which ties with your current investment price. Then separately means interest payment that you have paid it. Interest payment, expenses, record separately. That is 10,000. And then finally cash account credit. In this case, if you record it, then you don't need to post accounting entries for unrealized loss or whatever that, further part if you see. Why? Because in the investment, you won't be see any loss as such. The reason is we have recorded investment at net price, right? We have recorded investment at net price. Now question would be, sir, what if I wanted to record it like this only? You can record it. See, initially only. So it means at the time of launching fund or creating fund, you can submit your proposal to the regulators. Regulator will approve it or auditor will approve it, and accordingly you can do it. So it's not something that you should follow this method and that method. All right, you can follow that method as well. So that method becomes your capitalization of expenses. capitalization of expenses. So it means you can include directly. If you record total investment, it means you can record it to the asset side of balance sheet, right? Total investment account debit. But if you follow this approach, this is your bottom line approach. Sorry, top line approach, my bad. Top line, it means you can directly record it to the P&L. And if you want to record it in balance sheet to it, that's fine. That becomes your bottom line approach. Now the question would be like, sir, which approach is good? Both the approaches good, depends on means how you want to record it, but there won't be any impact on P&L and all. So for a time being, your asset looks like high, but eventually you would see loss of investment. So that loss you can transfer it to the P&L. That's the difference. But here, what we are doing, like as per the top line approach, we are already decided to record that interest expense to the P&L, and let's cut it out. We don't want to stretch that transaction or recording of entries in the books of fund. There won't be any change much.
So over here, the principal amount includes the interest amount of 10,000 already.
If you include that and if you want to record the combined portion as investment, that becomes your capitalization of expenses. That means if that you decided to record it in balance sheet. And in normal way, sometime you would may expect question like what are the types of accounting? So we have balance sheet based and P&L based accounting. So if you record total investment as this amount instead this, what is the difference between this? Where in a one transaction where we have recorded investment and interest expenses separately, and in other transactions we have combined it. We do not want to highlight that. So that becomes your balance sheet based accounting. And if you follow this approach, that becomes your P&L based accounting.
Okay.
All right. Okay. So I'll brief about tomorrow's session so that you can go through it. I'll send you one link. So from tomorrow onwards, we are done with the trade processing chapter. I'll send you the links. This trade processing you can apply it to the hedge fund, mutual fund, private equity. That's fine, right? But I would like to discuss about the financial products. Financial products, it means not equity bonds. I don't want to discuss that bonds and all. You can check my previous session. It means you can check my any session that covers that. But I would like to discuss the ABS, means complex product, ABS, from accounting perspective, and how that works in a private equity accounting. ABS, MBS, and CDO and CLO products. Because we are going to start that private equity discussion from tomorrow onward. But before that, I would like to discuss this products. Why these products? You will realize that because you would learn a lot of concepts like rollover, pay down, principal pay down, interest pay down, commitment, global commitment, securitization process, repayment, amortization, their accounting, or many more, means many more. So that's what I would like to cover, because in a sequence wise also private equity is aged one or old one, or it's a traditional method, I would say. So that I would like to cover that first, and then we'll jump on hedge fund. But the trade processing chapter, that applies to both hedge fund and private equity. It's not something that you can apply different logic to the private equity or different logic to the hedge fund. So we are done with the trade processing chapter, and so our next topic would be, I want to cover all of this. So don't miss on CDO, CLO, ABS, MBS part. Meanwhile, you can go through my blog. Already I have recorded several blog. Sorry,